Welcome back to 5 Good Questions. I'm your host, Jake Taylor. Our guest today is Victor Ricciardi. Victor is an assistant professor of financial management at Bachelor College. Professor Ricciardi is a leading expert on the academic literature and emerging research issues in behavioral finance and is editor of several e-journals distributed by the Social Science Research Network around behavioral finance. Today we're going to be discussing his book, Investor Behavior: The Psychology of Financial Planning and Investing. We're all seeking to minimize the impact of biases in our investing, so let's ask him 5 good questions. Welcome back to the show, everybody. My guest today is Victor Ricciardi, author of Investor Behavior. Hey, Victor, where are we chatting with you today?
I'm currently in Baltimore, Maryland.
Nice. And I really appreciate you taking the time out to be on the show. I think investor behavior and biases are some of the biggest things in investing right now that people are trying to solve. So it's great to talk to an expert on that.
Well, thank you for having me. I always enjoy talking about the topic.
Okay, so let's jump right into our 5 good questions. Question number 1, what's the number one bias that people are affected by, investors specifically, that they probably don't realize it? Kind of what's the most insidious of the biases?
I would say the one that really stands out to me would be an anchoring bias, in which we're essentially affected by our past decisions. And so essentially, if the decision is good, we tend to reflect on that. So for example, if you had invested in a particular stock and it went up in value, you reflect on that stock as a positive anchor, and that positive experience may make you more of a risk taker, versus a negative anchor can be either on a daily basis, a weekly basis, long term. So for many people, the financial crisis is still a major negative anchor, because if a person lost money, say they bought high and they sold low, at the end of the crisis, essentially they're traumatized. That negative experience really does the opposite. It essentially makes them highly risk averse at a time when the market's coming back, the last 6 years of a bull market.
Yeah.
And that really, so I would say that aspect of the anchoring bias really has a dramatic effect on people.
Yeah. I've often thought before, I've heard that Warren Buffett talk about his process a little bit. And one of the things he does is will look to try to figure out what a company is worth before he even goes and looks at the market price to see how close is he. And I think what he's doing there, I don't know if it's because he understood anchoring bias this whole time, or whether it was just it made sense to him, but he didn't want to have the market's input affecting his valuation of what he thought the business was worth.
Which is a nice rational strategy to take, but many of us do not have the self-discipline to filter out many of the biases. So I tend to think if you understand the biases you suffer for, and you're able to then put into place a disciplined strategy based on rationality, within the context of a portfolio, being diversified, being in the right risk tolerance, a decent asset allocation strategy. Also, I think rebalancing is very important, and also really being a long-term investor of at least 10 years or more. I think those simple things, if 95% of the American public did that, anybody, or 95% of the general population did that in any country, they would really be better off.
Yeah, if they had a more defined process that was a little more tied their hands a little bit more.
Exactly.
Yeah. So this question number 2, and it kind of ties in with that idea. The research I've seen typically indicates that the wisdom of the crowds comes when you have a very diverse population that are all making estimates about what something is worth, let's say. Given that the typical investor is kind of homogenous, really. I mean, typically white and affluent, and maybe even a lot of the same worldview. Would we maybe expect wisdom of the crowd not to apply particularly well to the stock market?
Well, it depends how what your the type of the crowd behavior that you're talking about. If you're talking about herd behavior in a bubble situation, and where everybody, even different groups, are get wrapped up in that stock price
Yeah.
keeps on going up,
They're
they don't
reading
look
the
at
same research.
yeah, they don't even do the research.
Yeah, they don't even do the
And
research.
so, if you look at the internet bubble of the 1990s, if you look at the housing bubble, all of these, all that crowd psychology is obviously detrimental to your wealth. Where group process may be good is if you look at the research on investment clubs, people who actually get together, also maybe it, some of the endowment committees of bigger colleges and universities that are really looking at and doing real research and taking a long-term look and have that diverse group, they probably make better decisions. So it's not a absolute in terms of the group behavior, but also, as I said, the herd behavior and other things that are detrimental in the group process are things like groupthink,
Yeah.
in which if you have one dominant leader in the group and you have just followers, nobody wants to raise an alternative opinion. And in investing, I think one of the good things to have is to have you want to have a say if you had a group, you would want to have growth investors and you would want to have value as investors in a balanced group to at least get contrary opinions and a well balanced discussion to make a better form group decision.
Yeah, I've heard of some shops that do that where they'll designate one person to be the devil's advocate and that person just tries to blow up the investment thesis as best they can.
And that's a good way to do it because even something like that helps overcome the anchoring bias. There are other biases such as representativeness, which is people draw conclusions about a little bit of information and they draw that conclusion into the future. So again, you want to get a fuller big picture, which would be the notion of modern portfolio theory and rationality, and that will hopefully help you make a better decision within your portfolio, whether as an individual or as a group.
Yeah. So transitioning a little bit, question number 3: financial scores in the U.S. And I imagine all over the world, but in the U.S. is probably the most studied, are pretty abysmal from what I've seen. What can we do to make that a little bit better, at least a
Well,
little bit?
I guess the two things that I see, especially that I teach now business students, a personal finance course, I would say if you look at the research as people who are actually trained in finance and investments are more likely to remember subject matter over the long term because they're dealing with it, they're interested in it,
Yeah.
and so forth. The other group, which is really the novice or investor or the people who, the general public, that typically lacks financial literacy, a key component that I've started to integrate into my own research and my own teaching is to try to utilize something like emotional intelligence, and that's really combining the research. I think really shows that you can combine the subject matter with a learning experience and some kind of physical activity, such as if you're teaching students, you do say the high school level, you do a stock market game. In my upper division classes, it's more difficult to say to do a stock market game, so I at least have them hypothetically follow a mutual fund. But also, what I do is I have them write reflection papers. I have them fill out very short surveys on how they feel about money. And so, also, I use humor in the classroom.
Yeah.
And so, as you're teaching the subject matter, if you can activate that part of the brain with the emotional intelligence, doing those different perspectives of how to teach differently, whether someone's a client with a financial planner, a professor with a student, that will, I think, over time makes the experience more meaningful, but then people are going to have more buy-in and also then take more responsibility for increasing their financial literacy.
So kind of moving the motivation from extrinsic to more intrinsic by making them just more curious about it and making it more visceral for them.
Exactly. So so again, if you're teaching students about stocks and you're just talking about total return, really doesn't mean anything.
Yeah.
So what I'll at least what I'll try to do is if I have them investing in an international company, many of my students at Goucher College do a study abroad experience. So I'll try to talk about a study abroad experience. I'll try to talk about if they did the study abroad experience, would they invest in that stock market? What was the impression of the economy? And so, having that personal relationship also with a client, if someone's a financial planner or advisor, is how to make those personal connections and create that personal narrative, I think is extremely important.
Yeah, you got to tell a story.
Mhm.
So question number 4. So a lot of investors that are nearing or reaching retirement are searching for yield in their years because the income becomes very important to them at that point. Um, and you hear these statistics about 10,000 baby boomers every day are reaching retirement age. So it's a pretty big issue. In a low interest rate environment that we're in right now, and you have people reaching for yield, do you think that there is a fair amount of unknown risk being assumed as people kind of are trying to grab a little bit more yield and they're moving out on the risk level a little bit and kind of unrealizing the risk that they're taking?
Yes, because especially people may not even understand the basic bond fund, for example. Something that I'm not categorically necessarily giving investment advice, but people don't even understand the inverse relationship where as interest rates rise,
Bond prices fall.
bond
Yeah.
prices fall. So the mechanics of a bond mutual fund really work is if you're doing an asset allocation strategy and you're looking for bonds, bond mutual funds aren't really may not protect principal. And so I think
Right.
the general public doesn't understand something like that.
Well, and
And so,
especially if you're in the middle of a 30-35 year bull market and bonds that we've been in, people don't even remember when interest rates were 15%, in the early 80s.
and even people don't even understand the notion of, but many people perceive the safety of bonds because of the protection of principal. Many people can't even understand the notion of interest rate risk, in which you may be protecting your principal, but your purchasing power is going to fall over time because you are over invested in bonds. And so I think back to that idea of having, even in retirement, having something in stocks and having more quality stocks with at least type of Warren Buffett type of companies that have a nice dividend yield. It's within I think not necessarily having the individual stocks, but having equity income or dividend income related mutual funds or ETFs is kind of the better way to go if
Yeah.
you're looking for some of that yield.
Yeah, I think that's right. I mean, we see that a lot with our clients actually in my investing business where they get to retirement age and they start to become nervous about being invested in the market. But really, the money that you're going to need, let's say 20 years from now, is no different than when you were 20 years old and you were thinking about it when you were 40, as opposed to, let's say, 50 to 70. So
And one other alternative that I think a lot of people don't always think of is high quality real estate gives you a nice yield. And I'm not talking about low quality shopping malls. If you're looking at something like office buildings, if you're looking at real estate that's high quality, credit A quality, for example, if a property owned, if a REIT or a real estate mutual fund owns property in which Walmart is a tenant. It's high quality. Even when the economy contracts or goes a into a recession, owning a portfolio of high quality rentals by a corporation probably has still about 95% occupancy because people still need a place to live. So there are ways to get that yield without chasing the yield as related, as I would say, to capital gains related stocks such as technology, and still looking at those more blue chips or, as I was saying, real estate or preferred type of stocks.
Yeah. So question number 5. Conventional academic wisdom has it that as a stock moves down in price, the risk is moving up if you measured it like as say as beta. So a higher beta stock from a stock that's moving down would mean riskier stock, and that basically then risk and return are positively correlated. A lot of value investors kind of have an opposite viewpoint that as the stock moves down, the risk starts getting smaller and smaller, and actually the potential return starts getting bigger and bigger. What do you think about that as far as, kind of from an academic, but also someone in the, with a behavioral finance skew?
Well, and I actually, even when I'm asked, do you think the stock market is overvalued? I may think it's overvalued, and then I have to, but then I realize even if I think it's overvalued, people will say, well, I'm going to lighten up on putting money in the stock market. But the thing is that we are pre-wired long term to always anticipate buying things as they're going up. But as I kind of realize, is even the years, again, if you're a long-term investor, when the market does decline, I have really taken a much reframed my thinking and looking at it as a buying opportunity.
Yeah.
Because you're going to buy more shares.
Right.
And again, and to also add to my comment before about rebalancing, risk tolerance, asset allocation, dollar cost averaging is another central aspect to how you simply ride the movements in the stock market, and I think that gets lost many times. The other comment I was going to say, the standard finance assumption is that historical risk, as you said, has a positive relationship between risk and return. I've done some research in this area, but there's also it also mentioned in my book, Investor Behavior. There's a strand of literature that talks about the notion of an inverse relationship between risk and return. Mm-hmm. And what that is based on my research area is the notion of risk perception, in which we're looking at the subjective aspect of risk into the future. And so, for example, if a person suffers from something known as familiarity bias, which we tend to overinvest in stocks or local portfolios or local companies, local mutual funds, we have a home bias. So for example, Coca-Cola is a name that most people know, and so people will perceive that as it's giving you a higher return, but because it's Coca-Cola, people perceive it as being lower risk. So that's an example of inverse relationship on the positive side. If you have an example I used in my classroom, when you had the BP oil spill several years ago, people perceived the name of BP as being highly risky, and people then expected to give you a high return. But then a classic example I use in my students is because of social investing, many will react, I will not invest in BP oil. But then I use the example of Exxon and the spill in Alaska, and then I said, after the 25 years after the spill, Exxon approximately increased in value over 1,000%. So it's amazing how many of the students who would have said they were social investors, when you show them 1,000% return, half of them change their behavior. So I think that inverse relationship, and also again giving that full picture, giving the familiarity bias is just looking at the name of the company, but then giving alternative data also impacts our investment decisions.
That's funny. So everybody has a price that they're willing to.
I think so. I don't know. I do. I admit it.
At least you admit it.
Yeah.
All
Well,
right.
that's half the therapy.
Yeah, that's half the solving the problem.
Yeah.
So question number 6 that we always ask is a bonus question about a book recommendation. And typically we're looking for something that is maybe a little under the radar. What do you have for us today?
Well, my current book that I supplement, which I use in my behavioral finance course at Goucher College, is a massive reference of 45 people contributed to my current book.
Yeah.
The book that I like to supplement it with is John Knopfsinger's The Psychology of Investing. It's about 150 pages. It gives a wonderful introduction um, to behavioral finance and investor behavior. And then it also ties in with a lot of the work I have in my current book, and I'm also working on a follow-up book with Ken Baker.
Oh, nice. Well, Victor, we really appreciate you having on the show today.
Oh, great. I'm glad to have appeared. Also, I wanted to mention if people want to follow me on Twitter, they could, if they just search for the term behavioral finance, I'll show up, or they could search by my full name, Victor Ricciardi, Ricciardi. Also, if you can put it on your website.
Sure.
All I do is I have no agenda, so all I do is post some of my own research. I post some of my own papers. I really post a lot of research and news stories that I find on behavioral finance and personal finance. And again, I'm trying to use my Twitter platform really to just increase people's emotional intelligence and to just ultimately introduce people to behavioral finance, but also my ultimate goal as an academic is just to increase people's financial literacy.
I like that a lot. Yeah, read about it on your Twitter feed before it shows up in the popular Gladwell adopts it and writes a book about it.
Exactly.
Well, Victor, thanks for coming on the show.
Thanks for having me.
Absolutely.